Hello and welcome to Finance RM. In this lesson, we will talk about basic accounting terms. So, the fundamentals of accounting. Accounting is the systematic process of recording, classifying, summarizing, and interpreting financial transactions to provide meaningful information for decision making key goals. Track financial performance, profitability. Track financial position, assets, liability, equity. Ensure compliance with legal and tax requirements. Provide transparency for investors, lenders, and regulators. Core principles relevant to the terms. Double entry system. Every transaction has two sides, a debit and a credit card, keeping the accounting equation balanced. And the accounting equation is assets equals liabilities plus equity. Accrual basis is revenues and expenses are not recorded when earned or incurred, not when cash changes hands. Consistency with the same methods applied across periods for comparability. Materiality, only significant transactions that could influence decisions are recorded. Core financial statement terms. These are building blocks you see on financial reports. Assets, definition, resources controlled by a business expected to bring future economic benefits. Types, current assets converted to cash or used within 12 months, cash accounts receivable inventory. Non-current assets, long-term use, property, equipment, patents. And key metrics, liquidity ratios often measure asset availability for obligations. Liabilities, the definition is obligations to pay money or provide services in the future, and the types include current liabilities due within 12 months and accounts payable, short-term loans. Non-current liabilities, long-term bonds, payable, leases. Interest linked, many liabilities accrue interest over time. Equity. Definition is that it's residual interest in assets after deducting liabilities, what owners own in net terms. Revenue, sales or income, money earned from selling goods or services before deducting expensive gross revenue, before returns, discounts, net revenue after deductions. Expenses is the cost incurred to generate revenue, rent, salaries, depreciation, and operating expenses include day-to-day operations, and non-operating expenses include in financing costs and one-time charges. Profit is gross profit is calculated from revenue, take away the cost of goods sold, and the operating profit is the gross profit, take away the operating expenses. The net profit is the operating profit, take away the taxes and interest. Next, the transaction and recording terms. Understanding these is essential for day-to-day accounting work. Debit and credit. Debit increases assets, expenses, decreases liabilities, equity, revenue. Credit increases liabilities, equity, revenue, decreases assets and expenses. Always recorded together to keep books balanced. And journal entries include original recording of transactions, and then there's ledgers, which are collection of all accounts, take away the groups, transactions by type. Chart of accountants, a structured list of all incomes and accounts used, assets, liabilities, equity, income, expenses. A trial balance is a list of ledger account balance to ensure total debits equals total credits. Adjusting entries is that entries at period end to update accounts for accruals, deferrals, and depreciation. Closing entries is that reset revenue and expense accounts to zero at the year end, transferring net profit to retained earnings. Next is valuation and analysis terms. These terms are crucial for interpreting financial data. Depreciation, allocation of asset cost over its useful life. Straight line method, equal amounts each year. Declining balance, larger expense early in asset's life. Amortization, like depreciation but for intangible assets like patents and software. Accruals, revenue earned or expenses incurred but not yet received or paid. Prepayments, payments made in advance for future benefits such as insurance or rent. Provisions, estimated liabilities, example the warranty claims and bad debts. Liquidity ratios, current ratio is the current assets divided by the current liabilities, and quick ratio, which is current assets take away inventory divided by the current liabilities. Then there's the profitability ratios, which is the net profit margin and the net profit divided by the revenue, and the return on equity, which is the net profit divided by the equity. Specialized on compliance terms, these are important for regulatory tax and audit contents. the GAAP and IFRS, which is the generally accepted accounting principles and the international financial reporting standards. There's audits, which is independent examination of financial statements for accuracy and compliance. Taxable income, which is profit after adjustments as defined by tax law, not always same as accounting profit. Deferred tax, which is temporary differences between accounting income and taxable income. And contingent liabilities, which is potential obligations dependent on future events such as lawsuits and guarantees. Working capital, which is current assets take away current liabilities, take away measured short-term liability. And break-even point, which is sale volume, where total revenue equals total costs. No profit, no loss. Thank you, and remember to be smart, stay smart, and achieve your financial goals. And don't forget to drop a like and subscribe to the channel and comment any queries or advice you have.